welcome back to the Cold Start Corner Live. I'm your host, Eric Matei, hanging out with Evon Mendrin. Evon is a certified financial planner, certified student loan professional. He's also the founder of Optometry Wealth Advisors. He's the host of Optometry Money podcast. Evon, really excited to have you here at the Cold Start Corner today for what is bound to be a really fascinating conversation all around tax planning for the modern cold start. But before we jump into it, man, thanks so much for coming on the show.
I appreciate it. I'm always excited to be here joining you. So Eric, I appreciate you having me back on once again.
Absolutely. Well, look, a lot to unpack here. So let's go ahead and jump right into it. And hey, for those tuning in live, however you may be joining us today, we're on a few of the socials going live. Feel free to drop your questions for Evon in the comments. And hey, if you are catching a rebroadcast here, we're going to have some information at the end of the broadcast that you can reach out to Evon directly, and you can always find the recording on the Akrinos YouTube channel. So Evon, we're having this conversation around tax planning for the profitable optometry cold start. And I think what prompted this is the fact that, well, both Optometry Wealth Advisors and Akrinos really specialize in working with doctors that are emerging practice owners in those early years of practice ownership. You reached out to me. We started this conversation around the fact that there's kind of this point that you hit 3 to 5 years after opening where it's kind of eye-opening, no pun intended, as to the tax side of things. So why don't we start by just very high level, just give us a lowdown of taxes. So for those viewers out there, emerging practice owners, just walk us through income taxes, what they are, why it's important that we kind of keep them all in order.
Yeah, I mean, income taxes are something that we all are required to pay according to the laws of this country. So income taxes are a tax on your income, right? If you pull up your tax return, you're going to see the first thing you're going to see is a list of almost every type of income that you can have. And so every type of income that you'll likely see, unless it's directly excluded by law, is going to be taxed in some way. And there's going to be some deductions in there, but eventually there's going to be some taxable income that you'll have. And it's it's an expense you'll have to prepare for and plan for.
Yeah. And definitely something that anyone in these early years of starting their practice should definitely plan for, because
Yes.
Whilst it certainly does take a little time to get the business ramped up, there's a lot of ways that a modern practice can really hit the ground running and
Yep.
get to sustained profitability in just a few short years. So while we're talking about taxes, still keeping it kind of high level, right? So income taxes, be prepared at the federal level, at the state level, with few exceptions. And as it were, though, why don't you break it down a little bit as far as different tax treatments under different organizational structures?
Yeah, and we'll try to keep this high level, right? And try to fit it in this conversation here. But I guess that's a good point to, talk with your professionals and do your due diligence to see what applies to your specific situation there. And as you mentioned there, a lot of what we're talking about will be related to federal taxes. Each state is different. Some states will have income taxation, others will not. So state to state, you might see something different for your particular state there. And as we talk about how different businesses are taxed, there's two general categories or buckets of businesses that are taxed differently. Number one is going to be a pass-through type business. So that's your sole proprietorship, S-Corporation, LLCs by default, partnerships. And what that means is that those businesses, even if they might file their own tax return, those entities don't pay their own taxes, income taxes, on a federal level. All of that taxable income is going to pass through and end up on your personal tax return. And it's going to be taxed at whatever tax rates your personal taxes are going to end up at. The other side of that is a C corporation, which is different. We'll talk about how a C corporation is taxed in a little bit, but it's all of your pass-through entities and your C corporation. And when you look at the different types of pass-through businesses, so sole proprietorship, for example, I don't know that you'll see much of those, but you don't actually have a business entity. It's just you doing business as yourself. You might have a name or doing business as, and you're going to see all of your net business income. You're going to see all of that show up on your tax return. You'll pull it up. You'll see other income. You'll go through there and you'll eventually see a Schedule C, right? So all of that will show up on your personal tax return. And all of that net business income, that taxable profit, is taxed from an income tax basis, as well as self-employment taxes. And self-employment taxes are Social Security taxes, Medicare taxes, all of those things that when you were employed, you paid half of those taxes and your employer paid the other half. And all that was deducted out for you automatically. Well, now that you are a business owner, that you're self-employed, you have to pay both sides of that. So that's roughly a 15% tax in order to cover those taxes. So that's something new that might be in addition to your life there, but that's something you'll want to plan for. An LLC is another one. So a limited liability company, by default, if you do absolutely nothing and you're the sole owner, it's going to be taxed pretty similarly to a sole proprietorship. So the main benefit there is liability protection. It's not necessarily this great tax strategy here. If you have more than one owner in an LLC, it's taxed as a partnership. Now, partnerships are complicated, to put it lightly. What you want to know about partnerships is that you're still considered technically self-employed, but with partnerships, you have a lot of more flexibility on how to divvy up the profits of the practice and how to divvy up the cash flow of the practice relative to some other forms. So that's how an LLC might be taxed by default, unless you decide to do something differently. But you can decide to change the way that your LLC is taxed. And that's where the S corporation comes in. And the S corporation is not an entity that you can go open. It's a way that your business chooses to be taxed. So you might have an LLC or a corporation, and you're choosing to be taxed as an S corporation. And there's important differences about how an S-Corp works, in that you are both an employee as well as a shareholder of that S-Corporation. So you're going to see on your tax return, you're going to get income from two different sources. A wage, you have to pay yourself, you're required to pay yourself a reasonable salary, a reasonable wage as the first dollars that come out to you in an S-Corporation. The second form of taxable income you'll see is just the profit in addition to that. So whatever's left over is going to be taxable business profit. In your wage, you have to pay yourself Social Security taxes, Medicare taxes, all of those employment taxes, just like you were an employee. But all of the taxable profit, you do not have to pay yourself self-employment taxes. So this is usually where people gravitate or choose to be taxed as an S-Corp, is to save those employment taxes on that business profit. But you have to have enough profit in order for that math to work out. Another thing about S-Corps is that compared to partnerships, you have a lot less flexibility on how to divvy up the profit between the different owners if you have more than one owner. You just have to do it based on your percentage of ownership there if you're doing distributions. Other than that, you have the corporation, which is the corporation. If you think about any publicly traded stock, corporation itself is going to pay its income tax at a flat 21% tax rate. And then if you pay yourself dividends out of the practice, those dividends are also taxable income to you. So there's two layers of taxation. They're double taxation. So you don't often see corporations in a practice or a service business where you're distributing a lot of that cash flow, but that's something that's there too.
So, and great breakdown there. And by the way, for viewers, I know you have some great resources over at optometrywealth.com that also digs a bit more into specifics from a structural standpoint.
Yes.
So again, Evon, thank you so much for providing that high level deep dive, because the fact is this: for many folks that are getting into cold start optometry practice, it's their first venture into entrepreneurship. And even if it's not their first venture into business and entrepreneurship, certainly a business of this nature where you're setting yourself up to perhaps realize, I mean, nothing guaranteed, but remarkable opportunity to have some significant cash flow through the entity. Let's talk a little bit about, digging deeper into tax considerations in those first few years of ownership. So, maybe if you can, and Evon, if you could also kind of break it down, maybe looking at the first, year or two into kind of like 3 to 5 years, and then kind of like that beyond 5 years.
Yeah, you think about from a cold start perspective, like those first year or two, what are you seeing in the business from a financial standpoint? It's a brand new business, so you're seeing relatively low collected revenue, and you're seeing a pretty decent amount of deductible business expenses in the form of either startup costs. You might be purchasing equipment afterwards. You might have those build out costs. So all of that capital, that it's a capital intensive startup. So you're going to have a pretty decent amount of deductible business expenses relative to a relatively low amount of, but hopefully growing collected revenue. So you're not likely to be concerned about paying taxes in these first couple of years, right? You're likely to see potentially losses, even potential losses that you'll be carrying over into the next couple of years. So from that standpoint, you're going to see usually relatively low taxable income in your household. Perhaps you have a spouse that's working that still has a relatively high steady income. You're potentially working, associating part-time in other practices, but compared to your future years, you're likely to see a relatively low taxable income. So there are some opportunities there to potentially add additional income into these relatively low tax years. And you're probably asking, why would you pay more tax on additional income? And the reason is because you want to think about tax planning as a lifetime endeavor. Like you want to pay the minimal amount of taxes as you can over your lifetime. And if you can pay taxes on income on a really low tax year relative to what it would be taxed at in the future, then you would rather take that opportunity to do that. So some examples of this, there may not be substantial examples, but some examples of this are Roth conversions, where if you have a pre-tax retirement account from your past work, there may be opportunities to convert some of those pre-tax dollars into a Roth type retirement account. You're going to pay taxes on the amount you do, but it will continue to grow in that Roth account tax-free. And as long as the rules are followed, in retirement, that growth can come out tax-free. So that's one example of you adding additional income into these lower tax years. If you have a taxable investment account, maybe you can sell some of those investments at a gain at a potentially 0% tax rate for the capital gains, and harvest those gains in that way. So, those early years, you're not going to be concerned about paying taxes because you're going to have relatively low taxable income.
Sure.
You want to keep an eye on your withholdings, making sure that that's going appropriately, but you may see opportunities to actually add additional income into those early years.
So here we are getting through those first couple of early years. And again, y'all, the takeaways here is going to be realizing, to Evon's point now, and I love how you so eloquently served it up, Evon. It's really important for folks you need to look at tax planning and financial planning. It's about the long game. So whenever you're talking tax strategy, it's all about considering how can you minimize taxes over your lifetime,
right?
With certainly expectations built in regarding perhaps what the realistic future will be looking like, and realizing those opportunities in the early years. Also, Evon mentioned some opportunities, converting retirement accounts to realize some tax benefits. Again, all about taking advantage of the fact that in all likelihood, this is going to be in all likelihood, and Evon, corrects me if I'm wrong, but in all likelihood, for anyone cold starting a practice or who has cold started a practice, the lowest tax bracket is going to be in those first couple of years. Probably.
I mean, hopefully, right? If you have a successful practice down the road, you should very well likely be in a much higher taxable income, which will lead to higher tax rates. So I would assume so. Those first couple of years are likely to be the lowest you'll see, hopefully. And there's some opportunities to take advantage of that.
Fantastic. Okay, so now here we are getting into really finding the stride of the practice. Let's talk a little bit about that year 3 to 5, which is like that sweet spot where that it really starts to accelerate. I tell you, Evon, it's funny. That often coincides from an operation standpoint. That 3 to 5 year mark is typically that mark where you're kind of starting to wonder, is my space too small, right?
Yeah.
Knowing that you're still going to have another 5 or 7 years left on that lease. But why don't you walk us through year 3 to 5? You're really starting to hit your stride. Let's talk about tax considerations at that stage.
Yeah. So think about what's happening in the business. Collected revenues hopefully increasing steadily. Your early business losses are eventually being used up. Or perhaps if you depreciated stuff earlier on, if you're able to accelerate that earlier, those depreciation deductions are starting to fall off. So you're seeing increased revenue and either steady or potentially decreasing losses or deductions, right? Which means that your taxable income is starting to increase because you're going to see more of that profit end up on your tax return. So what does that mean? Well, that means that you're going to have additional taxes to prepare for. Sometimes this happens suddenly, and sometimes this happens gradually, right? There's no exact path that everyone's going to be on, but I've seen at times where, and this is the case where owners have purchase practices as well, where they're seeing those early depreciation expenses fall off, and they're still seeing that collected revenue steadily increasing. So you might see this situation where you might have a considerable increase in your taxable income from the practice, your profits increasing, which means that your household taxable income is increasing, which means that your amount of tax is increasing, which leads to a few important things. Number one is that you want to make sure that you're preparing for that with your tax withholdings and or quarterly estimated payments. Because what can happen is that if you get to the end of the year where all of a sudden you realize that your tax is much higher than expected, there we go, right?
By the way, at recording, today's September the 12th. If you're catching this in the future, September the 12th. And Evon, what was that? I don't know, for those that may just be listening to it. It was by 10:40. That's due this week.
15th of this week, there is a quarterly payment due, right?
In the mailbox. Mailbox.
Or online. So you want to make sure that you're preparing for that, because what can happen is that if you get to the end of the year and you're surprised by the result, meaning you have a much higher tax than you're expecting, you're going to go into the next year having to get the cash to pay for that tax, as well as to start to pay the estimated payments for the following year. So as much as you can start to look at this increase in your taxable profit proactively, the much better off you are. So there's sort of this window that can happen where you're seeing that taxable profit increase.
So y'all, look, taxes suck. Paying quarterly sucks, especially to someone early in their cold start. But it doesn't suck as bad as not paying the quarterlies and having to catch up,
Yes.
given that if the estimates are off. And certainly there is the argument that, well, but if you pay them too much, then you're loaning them money interest free, what have you. But let's focus on the controllables, right? Because the controllables is, how can you be proactive about your tax strategy in those years 3 to 5?
Well, the top thing is just have open communication with your professionals. I mean, that's one of the biggest things, so that you cannot be caught off guard, is to have open, proactive conversations with your professionals. Most ideally, you have a financial advisor and a tax professional that are openly communicating, and people are watching sort of your financial progress over time.
At least they should be.
They should be. That's the ideal situation, is where there's open communication and your team is projecting this out and keeping you on task for that. And so ideally, you want to proactively talk with your professionals and then try to get a feel or a projection for how the tax year might go. And the next thing is just start to adjust your withholdings. The biggest thing outside of all of the fancy levers we can talk about is just being prepared for the tax. Is just making sure that you are adjusting withholdings. If you're an S corporation owner, if you're not an S corporation owner, it's about adjusting your quarterly estimated tax payments, or making them if you haven't been already, and starting to just get your payments on track for that tax due. Now, you're planning for a moving target, because ultimately you don't know how your business will perform throughout the rest of the year. So you want to look at that throughout the year, but you want to try to get as close as you can to that tax due. You don't want to overpay. You certainly don't want to underpay by a substantial amount. You want to try to aim for as much as that as you can. So those things are really just about being proactively communicating and just starting to prepare for that. And a lot of that has to do with how you manage the cash flow of the practice, because you want to have a way, before you start to distribute a lot of money out to yourself, you want to make sure that you have a process for setting aside dollars for tax payments. That can be in the practice, and then you distribute it to yourself at, each quarter, or you're just distributing it to yourself in your household and having a separate tax account to prepare for that. That's also about the cash flow planning of the practice too.
Yes.
Outside of that,
Great stuff.
there are some like tax levers you can think about pulling when it comes to that. So number one is reinvesting back into the practice. What does your business need in order to get yourself to the next level? Because you do ultimately, like, your focus in your journey here is not to lower your taxes at all costs. Your focus is to grow your revenue and your profit. So if there's ways to do that and you can reinvest back into the practice for a deductible business expense, do that. Right now, you don't want to purchase stuff like equipment just for the tax benefit. You want to make sure there's a business purpose to it and a return on that investment. But your first look should be how can I reinvest back into my practice in order to grow it? Outside of that, your retirement account in the business is a substantial tax lever, both from a tax planning standpoint as well as an investment standpoint. So long term, a 401k plan is going to be a huge opportunity there. You can contribute as an employee. You can contribute as an employer. So there's a lot of ways you can start to stack up the way you add to that plan for a deduction, either a deduction this year, or potentially if you're using those Roth contributions for future tax planning as well. So that can be a substantial opportunity there if you have the cash flow to do it. Now make sure you have cash in your business and a cash buffer in the household. But if you have cash flow, that's something to look into. Some other things to think about are if you find yourself with the opportunity to do this and you have the cash to do it, potentially purchasing the location or the real estate of your practice. Now, early on in the cold start, maybe this isn't the priority, but like you said, you're thinking about the lease. Maybe you're starting to outgrow the current space. Maybe you're looking at purchasing that next location. If you do that, and if certain conditions are met, usually if you are the sole owner of the practice and you're going to be the sole owner of the real estate, you can potentially group your real estate together from a tax standpoint with your practice, and you can potentially use real estate losses to offset your practice income. And normally, real estate losses are sort of held in this passive bubble where you can't use them to offset your working income or your practice income. But it's a little bit different here when you have this opportunity. So talk with your tax professional about that if that makes sense. Another thing on top of that, if you do decide that that's a route you want to go, talk with your professionals about doing a cost segregation study. And that's basically a way to look at your property, to separate all the different guts and types of stuff inside of the building and potentially accelerate some of that depreciation expense. If you see yourself with rapidly growing profit and taxable income, if you can start to accelerate those deductions and use the savings on taxes to just reinvest, and you're ultimately putting yourself in a better spot long term. So some things to think about. We can go on, but those are some high level things at least to think about it and talk with your professionals about.
Yeah, Evon, so many great insights across the board, and let's face it. I mean, the fact is this: modern optometry, independent optometry. There's never been a better time, and the future is bright, as it were. Heck, now is bright. It's amazing all the stuff going on in modern eye care, and it's important for doctors at any stage of the practice life cycle, but particularly those cold starting, understand this stuff. A lot of really great insights here. Evon, why don't you share with folks a little bit of the work you guys do over at Optometry Wealth Advisors? Also, maybe comment on how folks can get in touch with you to continue the conversation.
Yeah, I mean, one thing I'll say, just sort of wrap all this up, like for anyone watching or listening, your primary goal is to grow your business and to get increased revenue and increased profitability for whatever your business goals are and personal lifestyle goals are. Like your primary focus should not be on looking at every little loophole to minimize every little bit of tax. If you're seeing your total tax grow because you're growing a healthy business, that's actually a good thing. You're seeing progress there. And I said, because a lot of times we can get wrapped up in trying to spend tons of hours searching for these little deductions that sound fancy. And, part of it, I create content about stuff. So part of it's my fault because I talk about these things, but you don't want to spend all this time searching for these little impacts deductions where you can spend that time growing your business and having much more impact there. So
absolutely.
So keep your focus on the prize there. But so I own Optometry Wealth Advisors. That's a financial planning firm and investment management firm just for optometrists all over the country. You can find out more of our content and education at my website, optometrywealth.com, what you just saw there. There's an education hub there with all kinds of stuff. And then listen to the podcast, Optometry Money Podcast. I did a series on some of these considerations as well. Eric, you and I in the past did a series of videos on this. So check those out. And hopefully this has been helpful for at least thinking through some things to keep an eye on.
Yeah. Evon Mendrin, thank you so much for joining us here at the Cold Start Corner. Really great insights, all about that tax planning for cold starts in those early years and beyond. If you're looking for more great practice management, cold start content like this, subscribe to the Akrinos YouTube channel. Follow us on the socials and go check out Akrinos.com. We got a lot of really great resources out there. And hey, no matter where you are in your journey, we've got some really great ways that we can help you bring your vision to reality. Why? Because Akrinos is all about making the business of eye care approachable, accessible, and profitable. Go get it, y'all.